Hi, I'm Bert Taddei. I'm broker owner of Santino Properties Realty here in San Antonio, Texas. And I want to welcome everybody to another edition of the San Antonio Referral Room podcast. I'm joined today by a dear friend of mine and also my trusted lender partner, Pat Fitzgerald. He is a loan originator with USA Mortgage, and he's been in the business for over 20 years now. And he's my go-to guy as far as rates are concerned, anything related to mortgages, right? And he's a trusted a loan officer, and he's helped a number of my clients over the years. So, with that, thank you so much for joining us today. It's been a pleasure. I'm so glad we can have this time to reconnect. And we're so thrilled because I'm so thrilled that you're here because of the fact that we met, about 10 years ago. Oh, yeah. You were at the board offices giving a class, yeah, in VA loans to realtors like myself. Yeah, that's right. And one of the things that I think is special is that because we're in San Antonio, Military City, USA, obviously, right? Oh, yes. I would say, I don't know, maybe you have the number better than I do, but I'm figuring about 17% of the population in some way, shape, or form has ties to the military in San Antonio. So V loans it.
Oh, yeah, that wouldn't surprise me a bit. I know that there are over 200,000 retired military people living in and around Bexar County. And of course, our three active military bases, so all sorts of active military people that are serving there.
That's wonderful.
And of course, there's a lot of contractors that serve the military too with uh, former military people. So,
Yes,
yeah, big military presence here.
that's right. Yeah, I have a special place in my heart for the military. Because, I guess I've told you that my father was raised by a combat veteran from the Vietnam era. But my dad was a paratrooper. So, so thank you for being here. And in light of I really wanted to talk to you, especially now, because in light of our current, interest rate situation, right, or the climate, and the real estate market challenges, I thought it would be, apropos for us to talk about some truths about the market. And there's a lot of myths, really, honestly, surrounding, rates and that kind of thing. So I'm really stoked that you're here. And let's start with the obvious, pink elephant in the room, which is the subject of interest rates. And the FOMC, right, the Federal Open Market Committee, they met this past week, and Wednesday they lowered the rates by 25 basis points. Now, those are obviously the overnight funds rates for short-term loans, not so much mortgage necessarily. Right? Can you tell us a little bit about how those are tied into each other?
Yeah, that's a great question, Bert. And by the way, for those that don't know what a basis point is, a quarter of a point is equal to 25 basis points. So although when the Fed lowers the rates by a quarter of a point, it does not have a direct correlation instantly with mortgage rates, but it influences investors on where they invest their money, whether they buy these large bundles of mortgages and things like that. Typically, typically, as the Fed lowers rates, so do the mortgage rates begin to come down, but they are definitely not locked together. So it's widely anticipated that at the next Fed meeting, I believe it's in December, that there's going to be further reduction. Um, but we don't know that for sure, and sometimes the market becomes more and more sure of it, so it already bakes in what it thinks is going to happen. So even though the Fed lowered the rate, this last week, we didn't see any change the morning after. But generally speaking, rates are starting to come down, so it's a good thing.
Sure.
It's a good.
Well, I think that we can agree on one thing, which is that, there's a lot of pent-up demand, in the housing market. But I think that many buyers are currently on the sidelines,
No doubt.
waiting for rates to drop. In fact, I read in May 2025, so a few months ago, that across America, there were 1.9 million active sellers and compared to about 1.5 active home buyers. So that means that there was a shortage, literally 500,000 buyers for all the listings across America. And that's just May, before the busy season, you know, was going to start for real estate, which is, obviously traditionally, by April, certainly, people start, going out, emerging. With higher mortgage rates, of course, reducing buyer demand because they can afford less house.
Sure.
Purchasing power has diminished. So, what interest rate, at what interest rate or what range do you think it's going to be if we're going to start seeing buyers, in your opinion, begin to emerge again?
We're already seeing that. I've noticed in the last 30 days here, the activity has really increased.
Yeah.
There's a general feeling that rates are about to head down in a big way, and so I think people are paying more attention. Some of the people that are on the fence waiting can't wait any longer. Some of them needed to make a move for many reasons, divorce, family tragedy, school, changing kids' schools, all kinds of things like that. Well, it's just, yeah, life changes. But I am seeing a tremendous increase in activity lately. But I personally believe that that if we can get an interest rate that has a 5 in front of it, that's really gonna get people's attention and bring some of them off the fence. Are we ever gonna get back to the 2s? I really doubt it, but we can hope.
Certainly. So as I mentioned, we met, at the board office where I sent board of realtors, again, 10 years ago, and where you were giving a continuing education class, that's accredited by the state. So you're, widely regarded. I forgot to tell you, but the other day I was talking with a realtor on about one of my listings, and I mentioned your name, and she, oh yeah, yeah, the VA loan expert.
Yep.
So you're regarded here in the city, as a VA loan expert. And you have, of course, that notoriety, which is terrific. So let's talk about VA loans for a moment. Sure. Um, so what are some aspects of VA loans that you would say that veterans, by and large, are not aware of?
That's a great question, Bert. Probably the number one thing that I get asked about is what's the limit that a veteran can borrow? And President Trump, during his first term, took the cap off the limit. So today, there is no limit on how much a veteran can borrow to buy a home, so long as it meets with his income and payment capability. For example, last year I did a loan for a veteran in the Dominion. It was a $1.3 million loan, and he put nothing down.
That's
Yeah. So VA certainly allows that as long as they're capable of making the payments and the credit is, supports it.
such a terrific program.
Yeah. The other thing too, with a VA loan, there's never any PMI, private mortgage insurance. So that's one component that is just simply not in a house payment on a VA loan. You hear people talk about PITI, that's principal, interest, taxes, and insurance. With a conventional loan, an FHA loan, there's that fifth component, and that is private mortgage insurance. So that is never a part of a VA loan. So that makes the payment more affordable.
Sure.
A few other things too, Bert. VA does not have a minimum credit score like conventional does and things like that. So VA allows the lenders that administer the loan program to make their own decisions on where they draw the line for a minimum credit score.
Okay.
Yeah.
So then that's through VA, not necessarily the individual loaner mortgage company's underwriter.
Yeah, well, every mortgage company decides where they're going to draw the line on a minimum credit score. The other thing too is that all these closed loans, unless you're a very large bank that decides to service your own closed loans, these loans get transferred to servicers. The servicers will tell us what minimum score closed loans they'll accept. In other words, if we close a loan that's a VA loan with a 580 score, which is a pretty low score, many investors just simply won't buy those loans.
I see.
And so we have to,
Is there a true risky then?
yeah, they are considered risky, and there's a direct correlation with the lower the credit score, the higher the foreclosure rate and late payments and things like that. So
Let's kind of turn to Texas Vet. Okay, so the Texas Veterans Land Board, it's a terrific program, I think, right? And you're regarded, seems like year after year as one of the top lenders of Texas Vet in the state of Texas. So, can you talk to us a little bit more about the particulars of that program? And how does that work in correlation to RELO?
the Texas Veterans Land Board, and that land part can be a little confusing because people think, well, it's just a land loan program, and that's not true. They have three different loans. The biggest one, certainly in terms of dollars, is the home loan. Then they do have a land loan program where they will lend money to a veteran up to $150,000 to buy raw land. It doesn't work so good on a lot in the city because the lot has to be at least a minimum of 1 acre or larger. And then finally, they have a home improvement loan where a veteran can borrow up to $50,000 to do any kind of improvement on their home. That could be a fence, a new HVAC system, a new roof, redo the kitchen. It really doesn't matter. They just won't finance pools, hot tubs, and swing sets. No, what I call the fun stuff they won't do. But the Texas Veterans Land Board lends internally on the land program and the home improvement, but with regard to the home loan program, they rely on appointed lenders like ourselves and several other lenders to administer that program. Best way to look at it is an option that a veteran can or active military person can choose to go along with their VA loan. What do I mean by that? When we go to lock a VA loan, we can either lock it as a regular VA loan or we can lock it as a Texas Vet VA loan. There are definitely some additional costs involved to take advantage of that, but it almost always has the lowest interest rates that there are in the market.
Wow.
Yeah, yeah. They do have a lending limit, and right now it's 806,000. Very, very few of the loans that go through Texas Vet are anywhere near that high.
Sure, sure. Um, which is pretty good. All right. I mean, they doesn't have the unlimited that unlimited cap that we were talking about, with VA, right? But if you think about it, I mean, the FHA living in Bear County, for example, is 557 something rookie, right? So under for a single family. So it's actually
If we lived in an area where home prices were considerably higher than that, that could be a challenge. But if you most of the Texas Vet closed home loans are almost all of them are under 500.
okay.
So once in a while you have something like that.
What about participation fees? You said there's certain fees involved. What is it?
The Texas Veterans Land Board loan carries a 1% origination fee and a 1% participation fee. Best way to look at it is that's the price you pay to use that loan. But the interest rate, well, for example, right now as we're recording this, the interest rate is 5.15 for disabled vets, disabled of 30% service connected or more. 30% or more. Yeah, 5.15. It's a great deal. Now, if you had a disability of less than 30%, which would be either 10 or 20, or you're active military, then it would be a half a point higher, so 5.65. It's still, both of those rates are one.
Not for that's candy, yeah.
Yeah. So, yeah, it's not for everybody, but does definitely carry the lowest interest rate.
So remember we did the loan for my client Gracie, just a few months ago, and it's a perfect real world example. He was going through one of the I don't want to mention names of one of the sure the larger national sort of veterans sort of lending institutions. So they don't do Texas Vet loans.
Because they don't even talk about it.
Yes.
Yeah.
You don't need Texas Vet. And we were talking about rate buy downs because that's a big thing that I've been talking about because of my videos and so forth on my YouTube channels. Bert sells San Antonio real estate. Right. Sure. We're coming up on 200 videos now, and they're almost all real nature.
I really like your videos.
Yeah, so I'm excited about that. So both my audience will kind of visit the channel.
Yeah, absolutely.
In fact, this where this podcast will be hosted as well.
Great.
But my point is that uh, we were talking about buying down her rate with one of those other companies,
Great.
and with the participation fee that she paid, she did not have to buy down the rate at all because Texas Vet was so much lower than what they were offering her that buy down component wasn't even
Yeah.
something that we had to discuss. It was
Yeah, she was really pleased to find that out,
yeah, it's so exciting.
Yeah.
Now changing the subject, you're originally from the Midwest.
Yep.
Okay. Michigan.
Born and raised in Grand Rapids, Michigan.
Yeah, that's a lot.
I left as soon as I
Snow belt. Yeah, it's belt. It's not like okay, snows and stuff. Yeah, that's something. So I work with a lot of relocation traffic, as you know. Be it for jobs, military PCS, a better cost of living, things of that nature. Uh, if a winter Texan, let's say for example, would want to own here, what are some of the requirements that they should consider? In terms of like down payments, amounts, and things of that nature.
Well, certainly one of the very first questions that I ask everybody when I get them on the telephone is this going to be your primary residence? Sometimes people hesitate. Most people know what that means. Is this where you're going to live as your quote unquote home?
Sure.
Uh, if you are, then that opens up the door to all of the best programs that we have. If you're not, and it's going to be your second home, then that limits us to a 10% down conventional loan. And if it's going to be destined to be a rental property or a Airbnb, something like that, then that's a pure investment property that's going to require 20% down.
Right.
Yeah.
Okay.
So,
Okay. So real basic question, right? Is this a good time to buy in spite of the higher rates?
oh, it's a great time to buy. I personally bought a house 3 months ago, and I really got a great deal on it. And I really feel the reason that I did is there's lots of inventory available right now, and that definitely has slowed things down. And so I made an offer that was ridiculously low, and they took it. I'm so surprised. Um, but yeah, it's an excellent time to buy right now.
Especially if it's the home is vacant, which I think this one
Oh yeah,
was, right?
yeah. The one I purchased was vacant. Yeah, they want that home sold, and if you wait until rates come down, that excess inventory is going to be gobbled up pretty quickly, and then we're going to be right back to the multiple offer situation. Huh? Prices will go up, rates will come down, and everybody will be standing in line again, like you remember, trying to get an offer accepted.
Yeah.
That's a frustrating way to do business.
That's right. They were literally, I was just talking to a client about that the other day. I just started, working with this couple, the nice couple. I looking to downsize. I'm coming move out of that 2-story house and to a 1-story now. Their kids are grown and out of the house. And I told them, I said, literally during the pandemic, there were like groups of people
Oh,
in line to view the house.
I remember you telling me a story that you put an offer on a house in Churchill, that there were 20 some offers in that house. Or was that weekend? That's unbelievable to me. But I've heard stories from realtors that I do business with that they were literally standing in line and in the front yard waiting to walk their clients in to show houses. And I thought, wow, I hope we never go back to those
Yes,
days.
and yeah,
And then you're going to pay premium for the house or more.
that's right. Yeah, yes, and so that's why I agree with you completely. I tell folks that all the time. Is that right now is a terrific time to buy because guess what? You can always negotiate for closing costs.
Oh, absolutely.
To have the seller contribute to try to buy that rate down.
Actually, that is a great thing that you just brought up right now because every single contract that I see coming in has the seller paying all or part of the closing costs. Every single one of them right now.
Okay.
So those people that buy houses now are the smart ones because this is the time to buy it.
Sure. Well, sure, because now because people say, "Well, yeah, but new construction, they'll pay your closing costs, they'll do this and that." I said,
It's all happens there.
"Right." Number 1.
So free money other.
Number 2, where do you where do you wanna live? You wanna live out in the middle of nowhere, right? Because let's face it, San Antonio's all built out now.
Yeah, yeah.
I mean, it's for the most part, it's
I like a neighborhood that looks a little more lifted and the trees are mature and the landscaping is in and sure, yeah, that's
so the same incentives that the home builders are offering, you can have that same thing as we move into it in a home that's closer to work and to church and wherever, you wanna live and closer to, better commute and that kinda thing, with the mature trees, and sellers are willing to participate, sort of by and large, to help you with those closing costs. I think that's more
seeing it every day right now. We're seeing it.
yes,
This is the time to buy.
that's right. And by the way, this is September 2025, in case anybody is wondering when we sorry, filmed this video, right? And I hear on TV that unless you have the 20% down payment saved, you can't really buy a home.
Oh gosh, that's true or false? False all the way. We had many 100% programs. Well, as we just mentioned, the VA program, there's no down payment there. If a client is buying a home that's out of the county, then the USDA program comes into focus. That's a conventional loan that mimics a VA loan, so there's no down payment on that one either. So I was just thinking, don't listen to the national news and what they talk about with mortgage. They truly don't know what they're talking about.
Yes. Yes. And you'd be surprised how many homes that are not necessarily in rural areas that still qualify for USDA. I tell people they ask me about that.
Absolutely.
Yeah.
Yep.
Now, how does down payment assistance really work?
Great question. Down payment assistance is very popular in Texas right now. The state of Texas has a couple of three programs for that clients can participate in, and there's another program in the Houston area that we can use. But basically, down payment assistance, the way it works is the state of Texas has formed some nonprofit organizations that funnel the money by basically charging the client a little bit more for the interest rate. That creates excess money, and so they run that money through the nonprofit organization, which satisfies Fannie Mae and Freddie Mac that it's not a gift from an outside party that wouldn't be legal. But today we can get a client up to 5% of the purchase price of a home to help with their down payment and their closing costs. When you combine that with a VA loan or a USDA loan, we get that client into that house with literally nothing out of their pocket.
Incredible.
Nothing.
Yeah. These are the kind of
Yeah.
nuggets, if you will, right, that I want for my audience to hear, because a lot of folks don't know that that's available to them.
Oh, yeah. And a lot of people think, well, I bought a home in my life, so I don't qualify. That's really not true either because one of the DPA programs that we use doesn't even have a first-time buyer rule.
Zarek.
So people can come back after 3 years and be treated as a first-time home buyer again. Now, I will tell you this, that there are some rules on down payment assistance. B Both parties, if there's 2 people borrowing, they must have a 620 credit score, both of them.
Okay.
Middle credit score, as we call it, because we pull from the big 3 bureaus, Experian, TransUnion, Equifax. That middle numeric score must be a 620 or better.
Yeah.
The other thing is there's income limits. In Bexar County, depending on the program, it can be as much as $115,000. In some of the other surrounding counties, it's a little bit lower. Kendall County, oddly enough, is even higher than Bexar County. But anyway, there are income limits on that. So people that are making the 125 and up, they no longer qualify for it.
How about job requirements?
They want to see that you're full-time in your position and verifiable income. They want to see that you've been on a job in a full-time capacity for a couple of years.
Okay.
Yeah, don't have to be on the same job for a couple of years, but they wanna see that you've been working full-time for at least a couple of years.
Yeah. Uh, Real quick, you mentioned something about first-time home buyers. Generally speaking, for most loans, how many years must it be that someone has not owned in order for them to
3 years.
3 years, okay, so it is 3 years for just about all types
Yep.
here. What are the best down payment assistance programs currently available?
Well, I don't know about best. All of them are pretty much the same. The big question is how much help do we need? Help meaning, does the client have their closing costs, but they don't have their down payment? For example, on an FHA loan, pardon me, an FHA loan has a 3.5% down payment. So if the client has their down payment, but they need help with closing costs, then we're only going to need about 3% help. But if they're short on both, then we can go to 4% or even 5%. 5% is not available every single day. We log on and we see what's available with the institution, and almost always we can get 4%. But I just locked one last Friday or a week ago Friday at with 5% help.
Okay.
Um, but generally speaking, we see mostly 4% help.
Now, because traditionally, and I'm talking about FHA compared to conventional, FHA's almost always has lower rates.
I do. FHA and VA typically are going to have at least a quarter of a point better
Okay.
interest rate
Okay.
than
And
conventional.
so, some conversely speaking, on that last point we were just talking about, is there a limit as to how much down payment one can put on an FHA loan? So they don't want to do just the 3.5%. Can they
Oh yeah, they even put down more.
put more money down if they want to take advantage of that lower rate?
All the loans allow for more down payment to be put down. It makes the loan safer and sure makes you look better on paper when you're going for your approval.
Okay. Sounds good. Are there any downfalls to choosing FHA as opposed to conventional?
Well, FHA has their own private mortgage insurance, and it's mandatory on every single FHA loan. If you put down the standard 3.5%, that private mortgage insurance is on that loan for life. If you put down if you put down, I believe it's 10%, then it goes off the loan after 10 years.
Oh, that's actually.
Uh-huh. So, you know, people that are more savvy, that don't want that PMI, sometimes they'll look at going conventional, bite the bullet, pay the 5% down for down payment, and then get help for the rest of it. And then that PMI can go off that loan. It can go off at the 2-year point if the value has come up.
Right.
Yeah. The magic to get PMI taken off of a conventional loan is you have to be able to prove to the lender that's currently holding the loan that the market value of the house is now 20% more than what you owe on it.
This is a question I'm going to ask that I know the answer to, but I want for you to tell us. Does the lender do that automatically?
No, I know. No, you have to ask.
I tell folks that all the time. Just consult me. I'm more than happy to give you, a no obligation home value, and kind of see where it's at, value wise versus what your loan to value is at this moment, or your LTV. And I think that that's a great way to save on a monthly payment if you have a conventional.
Oh, there's no doubt about it. There are a couple other little tricks that I want to share with you too on a conventional loan, and that is, and it works best for people that have nice higher credit scores. But instead of paying the monthly PMI and waiting and hoping for the value of the home to go up, you can pay a reduced amount up front. It's called single premium PMI, whereby you pay that insurance up front, and then there's no PMI put on your loan. Yeah, and that starts at 5% down on conventional and 10% and 15%, so on.
Okay.
Here's a great example. I just closed a loan. It was a $360,000 purchase. The gentleman put down 10%, and he had very nice credit scores. They were in the high 700s. He paid one time $1,800 up front, and no PMI went on the loan.
Wow.
Yeah, that's a great deal because that PMI would have been easily 100, low hundreds per month. So it made all the sense in the world to pay it up front.
We were talking a minute ago about seller contributions for closing costs and things of that nature, right? And we're finding that buying down the rate is something that's very popular right now. And I wanted to ask, what are the conventional loan limits for seller contributions?
Perfect question. Um, if you're putting down just 5% on a conventional loan, the max a seller can contribute is 3%.
Okay,
3%. If you go to a 10% down payment on a conventional loan, then it's 6%.
6%. Yeah.
The only thing that deviates from that on a conventional loan, Bert, is on an investment property. When you're buying a home that's going to be a rental, 2% is the max that a seller can contribute.
Okay. How about FHA?
6%.
Okay. And the aforementioned VA
Well, yeah,
is the big one.
4%, but that does not include prepaids.
Okay.
So it's really higher.
I was going to say, however, didn't we talk recently, you and I, about how your underwriters have allowed for even more
Oh, sure, to contribute. Yeah.
to help?
Yeah, the VA allows their appointed underwriters. In order to be an underwriter for VA, you have to go through testing and be a licensed VA underwriter. And so they allow the VA underwriters a pretty wide discretionary decision making.
Okay.
Yeah, the VA wants veterans to have homes, and they always want the underwriter to give the veteran the benefit of the doubt. And so we see a lot of really positive decisions in that regard.
Sure. Now, as far as the amounts of eligibility, how does that work? Because I know that there's a certain amount that a veteran is eligible depending on their DD 214, right?
Well, it's depending really on do they have any other usage of their VA for housing purposes. If they have a clean a certificate of eligibility right now, then it's unlimited based on what their payment capabilities are.
Okay.
In other words, a veteran that makes $100,000 a year is not going to qualify for $1 million home. So that has to fall into line. But the only time that the old rules come into effect is if you currently have a VA loan that you've converted maybe into a rental property, or it's in another city, especially with active military people, when they get orders to transfer, if they can't sell their house or don't want to, then they can turn it into a rental. All right, so then they get to their next city and they want to use their VA again. There are some limits as to how much more they can borrow. And there's a formula with that.
There's a
Yeah, we enter it into a spreadsheet that we have, and that lets us know what the limit is.
sure, because in my real estate experience, I've noticed that a lot of folks will PCS, they're that permanent change of station here in San Antonio, and they're leaving behind in Louisville, Kentucky, a another property with which is bought with the eligibility of the veteran's eligibility of the heir, so they only have so much eligibility left, I guess, to apply.
But now that the conforming limit has gone up over $800,000, that brings those numbers up very nicely with the VA. So if we see a veteran has purchased let's say a $300,000 home in another area,
Sure.
they can easily do that again here.
Interesting. Yeah. Okay. All right. Well,
Yeah.
this
And you way back, you asked earlier in our meeting here, some of the things that people don't know, but a lot of lenders will look at a veteran or an active military's credit report and say, well, you're already using your VA, you can't use it again. And that just could not be farther from the truth. You absolutely can add two VA loans. The only thing that the VA underwriter is going to ask is, I see you have a VA loan in place. Why do you need another one? Especially if they're both here in San Antonio, for example. All I want to know is what you're doing and why. My family has grown, or my family, my kids have grown up and they've moved out, or I've got bad knees and I can't climb those stairs anymore. Any number of reasons. They just want it to make sense. They just want to know why. It's not yes or no. They just want it to make sense.
Right.
And I've never had a VA loan turned down for a reason that the VA underwriter didn't like or accept. Never.
Okay. Termites. That DI report, that we're destroying and destroying insect report. Yeah. Seller has to pay for it.
No,
True or false? Okay.
false. Anybody can pay for it.
Okay.
But that is mandatory on a VA home loan purchase all the way across the nation in what's called the Sun Belt. Because the VA knows that homes that are in the Sun Belt, and that can be all the way from California all the way to North Carolina, those homes and everything south of that in our Sun Belt, termites are a part of our crop because it rarely gets cold enough to kill them all off. So, but termites are not the only part of the wood-destroying insect. It can be carpenter ants and other things. So, me personally, I'm not a veteran, but every home that I buy, I get a termite report done on it.
That's great.
And
Good advice.
yeah, absolutely, and I get one every year. Because if you do that, the cost of it is far cheaper than waiting until you get them
Yeah,
and then paying to eradicate them.
that's for sure.
Yeah.
Yes.
So,
So as we round third base and head for home,
yes, sir.
let me ask you, what is a soft credit pool?
That's a great question. People, that's one of the number one questions that I get from a client when we begin to discuss a potential mortgage, and that is, are you going to do a hard pull on me? And my answer is no. We can do what's called a soft credit pull, which I do on every single loan. That's the same thing that insurance companies do when you're asking for homeowners insurance or car insurance. They want to know how your credit score looks. So believe it or not, credit scores have a huge effect on with insurance companies on how much claim activity they're going to have. So bottom line is we do a single bureau soft pull, and it brings in the debts. It brings in the car payments, the minimum credit card payments and all that, so we can work our numbers in our software and tell a client how much they qualify for. So you might be thinking, well, how can you do that by just pulling one bureau? Most of the major creditors report to all three majors. So we see a lot of redundancy there. We don't need to pull from all three on the soft pull. That way it does not show on the client's credit report that suited their credit.
Right. And there's no points are counted against it.
That's correct.
Okay. Yeah, because I was speaking with a potential client just this morning, and I told her that. She said, "Well, yeah, but what is that going to cost me in terms of my points and stuff?" And
Zero.
yeah, she came to me from a coworker whose friend's friend said, "Oh, call this guy Bert Taddei." So I wanted to assure her, that was indeed the case. So I wanted to make sure we got clarification on that. And it sounds like it's enough to know if they're on the right track to be kind of
Oh, absolutely. And that can also tell us immediately if this client is capable of buying a house right now.
fair.
And if not, and we have a lot of credit challenged people in South Texas. If it's not right now, then I'm happy to sit down with them and let's come up with a program to get you credit worthy, get you ready.
Sure.
I'm happy to do that and explain to them what's bringing those scores down and how we can improve it. When you do it as long as I've been doing it, you learn a lot about credit and what affects the scores.
Sure.
So,
How about credit repair? Because I get that question a lot.
yeah, there's a lot of confusion about credit repair, but the biggest part of credit repair is, of course, stop paying anything late immediately. But also, it's basically a letter writing campaign. When you send a letter to any credit bureau, by federal law, they have to respond to you, unless, of course, you send it every month with the same question and the same everything. Then they consider your letter frivolous. But honest letters that go to the bureau questioning something requires the Bureau to either make a decision to take it off or to open up an investigation with that creditor and verify, is that really true that that client paid low, paid late, or slow? Okay. Many times those letters are ignored by the creditor, and if those are not responded back to the Bureau within 30 days, federal law says the Bureau has to take it off. So a lot of items come off credit just because the ultimate creditor is too lazy to respond to the letter. They still don't have the manpower. Okay. So anyway, the other thing, one last thing about your credit, medical collections are, even though they're on somebody's report and they do affect the scores, we the collective attitude of the mortgage industry is we ignore those collections, and we ignore all the medical reporting with the credit bureau, because the medical reporting and credit is pretty much out of control, and so we take that into consideration.
Okay.
You know, if somebody's had let's say they had a bout with cancer or a serious car wreck and they got injured, if we can isolate what happened and when, that makes for a very viable story that we can share with the underwriter as to what happened with that person. It was an isolated event during this part of their life, and so the underwriter pays attention to that.
Is that something that just came about recently, or is it always existed?
Always been that way. In fact, there's some pending legislation right now to eliminate medical reporting in general, because I think a lot of the congressmen and senators even have things that get reported on their credit. So yeah, there's a lot of support right now for eliminating negative medical reporting.
Okay, but real quick, the WDI thing we were talking about a minute ago, that's something that did change though, right? Or has it always been
No, it's always been
one negotiation? Who pays for it?
you may who
Yeah,
pays for it?
yeah.
I don't remember ever a time where this seller had to pay for it, and I've been doing this for 22 years now.
That's a myth that I have. My whole career, the sellers to pay for it.
Yeah,
But it's yeah.
nice try though, Bert.
Yeah. Well, when I'm on the buy side, the listing side, I don't want my seller here, right? It's an extra $150 or whatever. We could save them. So part of the reason why I wanted to, again, to invite you, to participate in the podcast was just really to dispel some of these myths that we're talking about here, and really just kind of get a better sense for what's going on, with interest rates right now.
Sure.
And so I thought it was really apropos that we had a nice, chat. And I'd love to invite you back, as things continue to, like we were just talking about, things continue to evolve in the lending industry, and rates, continue to perhaps change into a different trajectory. We would love to have you back. So
Well, I'd love to do it.
thank you again for joining. Thanks for having me. So I enjoyed it. Okay. Thank you. So that's it for now. Once again, I'm Realtor Bert Taddei. I'm broker owner of Santino Properties Realty here in San Antonio, Texas. And we're glad you were able to join us here for another episode of the San Antonio Referral Room. Thanks for watching.